Hello and welcome to this weekly market recap for the week ending Wednesday, December 18th, 2024. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. It's a pleasure to be with you this week, although I'd certainly rather have some more bullish results after what we saw today. We'll get into that in just a minute, but we did see the Fed come to a conclusion today, the Fed meeting. It started yesterday morning, Tuesday morning, and today, Wednesday at 2 p.m., they announced that they were cutting interest rates again by another quarter point, which now brings us to a 100 basis point cut for 2024. Unfortunately, after that announcement, the Fed adjusted the number of rate cuts that they were expecting to have in 2025, and that definitely resulted in a negative tone this afternoon, very negative tone. So for 2025, instead of expecting 4 rate cuts, now they're saying 2 rate cuts for 2025, and they're not thinking that they're going to hit their target inflation rate of 2% until sometime in 2027. So the combination there that spooked the market. We're going to go over all of that in just a minute, but that's really the backdrop. So what I'm going to do today is I'm going to talk a little bit about what's happened over the last week, but then I really want to focus on what happened today because it was new news. We saw a lot of changes take place in the market, mostly for the negative, and I just want to go through all of that with you and show you what I think we need to be thinking about as we move forward. So let's go ahead and start off with what happened today. The Dow Jones, you can see, down 1,123 points. That was more than 2.5%. S&P 500 down almost 3% today. Nasdaq more than 3.5%. If you go down here to the Nasdaq 100, you'll see 3.6%. Small caps down more than 4%. Mid caps 3.8%. I mean, just everywhere you look across the board, just a lot of down, unless you look at the Volatility Index, which jumped 11.75 points today. Remember, I was talking recently about things look good. Volatility Index was remaining low. That's not the case now. After today, the VIX 27.62. Anything above 20 bothers me. Normally, I don't want to be in the market while the VIX is, going through. You see how quickly the market sells off when that VIX goes through 20. We saw that very plainly this afternoon in the final 2 hours of trading. But that represented a 74% increase in the VIX today in just one day. And so quickly, the market has gone from somewhat complacent based on the VIX to extremely fearful. So we've got to take that into account because the market's not rational when you've got a VIX reading up at 27. So things could get worse before they get better. It's also important to note that this week is options expiration week for the month of December. So Friday is our monthly option expiration day. We literally just had a Max Payne webinar with our members on Tuesday after the close, and we talked about the possibility of exactly this taking place. And I also talked about the possibility of the Fed announcement being a catalyst. I didn't think that the Fed was going to do what they did, but I said if they ended up lowering the number of expected rate cuts in 2025, that could be a catalyst to get the ball rolling to the downside to help market makers eliminate a lot of net in the money call premium. And trust me, if you were holding calls today, you probably saw a lot of value eliminated based on all of this movement. But let's take a quick look at what's happened over the last week, and then I'll come back to the daily today and some of the impacts. So first, I just want to show you that over the last week, Nasdaq's been down 2.5%, or is down 2.5%. Russell 2000 down almost 7% over that same time frame. So I've been a fan of small caps. Today, small caps got hit pretty hard. We've seen it already in December, the Dow getting hit to the downside, small caps being hit to the downside, while many of the Mag 7 stocks were performing really well in December. I think some of that may have been the market anticipating exactly what we saw today. That's kind of what makes sense to me anyhow. Will that change as we go forward? I don't know, but we'll talk a little bit more about that in a bit. But just know that overall, it was bad across the board, but it was particularly bad with the Russell 2000, the small caps, the mid caps, and even those transports, which dropped 5% over the last week. Now, if we look at the sectors over the last week, you see staples and discretionary among the leaders. They went down, everything went down. But if I'm thinking about, okay, fewer rate cuts, I'm thinking also that's not going to be great for the economy. But yet, staples and discretionary, two consumer areas, were up near the top of the leaderboard. So it just kind of makes you scratch your head and think a little bit. Technology, laden with growth stocks, down 3% for the week, which is just unusual when you compare it to other areas of the market, other areas getting hit harder. Energy, materials, real estate, industrials, financials, more value-oriented stocks were hit the hardest over the last week. And it seems like some of the more aggressive areas kind of skated by without nearly as much damage. Just an interesting point I wanted to make there. Looking at the key indices today, we just went over that, so I'm not going to spend a lot of time here. Saw all those numbers, but let's move on to the sectors for today, because today was a big day. At 2 o'clock, we got an announcement from the Fed. They changed a lot of what they had talked about in the past. And one thing that kind of bothers me with this Fed, I've said before, I'm not a big fan of this Fed Chief Powell, is that it wasn't that long ago that the Fed came out and admitted that that they expected to see inflation moderate around that 3% level and be more stubborn, trying to get down to the 2% level. And now, few months later, we're actually using that as an excuse to cut the rates, the number of rate cuts from 4 down to 2. Well, they seem to be expecting that before. So I'm not quite sure why that made the adjustment from 4 to 2. Anyhow, again, I'm just giving you my opinion on how this has all gone down. But for today, you can see discretionary, which had done pretty well for the week. Discretionary did get hit pretty hard today. And relative to staples, which actually held up pretty well, that actually took down that ratio. And I'll show you that a little bit later in the program. 10-year Treasury yield. I thought this was interesting. Now, remember, this is the longer term, the longer end of the yield curve. This isn't impacted by the rate cut per se. The rate cut is all about short-term rates. The long-term rates, and what I saw here in the 10-year Treasury yield, with the yield going up, that means that folks are getting out of bonds. And so to me, that's an indication that perhaps the bond market is worried a little bit more about inflation on the one hand, or possibly that they believe that maybe there'll be some weakness, or maybe we won't see as much economic strength as a result of what we would ordinarily look for with 3 rate cuts this year, four next year. But again, that's been cut to 2. So I'm going to kind of watch and see. This is a pretty interesting chart, but we closed over 449 today on the 10-year Treasury yield. And that's the highest close that we have seen since going back toward the end of May. So folks getting out of bonds, sending the yields higher to the highest level since sometime back in late May, that bears watching. So it's an area I definitely want to take a look at. The volatility, as I mentioned earlier, I mean, look at this move to the upside. Moving back through this triple top, it just seemed to be no real end in sight for the VIX rising. I mean, look at what happened. I'm going to go on an intraday chart. Here's 2 o'clock. From the moment that Fed Chief Powell began to speak, you can see that VIX just absolutely just kept moving higher and higher, showing more and more fear in the market. And while we're watching that, if I show you the S&P 500, going the opposite way. And that's what we're normally used to. When the S&P goes down, it triggers the VIX higher. And when you start talking about, a 178-point drop in the S&P 500, almost 3%, it's not surprising that we saw a big move higher in the VIX. Although 74% rise seems like a lot, maybe more than it should have been. But hey, it is what it is. We just have to go with what we're seeing. Before I show you a few more charts and wrap up today, I do want to go over to EarningsBeats.com and show you a couple things. Number one, we have a 30-day free trial. You can start at any time. Just click that button. You will have to provide credit card for that. And again, this is at EarningsBeats.com. Both names are plural, EarningsBeats.com. If you scroll down, I'll show you some. We've got a big event coming up 2 weeks from this Saturday. Market Vision 2025. This is where I give my forecast for the year. Last 5 forecasts I've given have been pretty darn accurate. Got a little bit more to deal with now with what the Fed talked about this afternoon. So this is going to be an interesting Market Vision 2025 coming up. I had my thoughts in my head. Some of what we saw today may or may not change those. I'm going to be watching pretty closely over the next couple weeks to see how the market trades. But anyway, we'll get back into that in a second. There is also a free newsletter that you can sign up for. Our Earnings Beats Digest comes out Mondays and Wednesday mornings each week. It's free. There's no credit card required for this. Simply type in your name and your email address right in the box provided there. Hit that subscribe button and you'll be set up. But let's go back up here for a minute and let's talk about this event, Market Vision 2025. If you click on that, it'll bring you to this page where it goes through and discusses some of the things that we're going to be addressing at this event. Of course, my partner, John Hopkins, and I may be making my boldest call. If you followed me for years, you know I've made some pretty bold calls, kind of going against the grain. This might be the boldest ever. I'm not sure. But we're also going to have Dave Keller join us. Of course, you know Dave. He has a market misbehavior podcast now. Really looking forward to talking to Dave a little bit and getting his thoughts on how he sees the market maybe evolving in 2025. But anyway, you can go through, you can check out all this when you get some time. Here are actually some of the calls from prior Market Vision events. You can go back and you can read those. I think I've been pretty darn accurate, eerily accurate over the last 5 years. I find it easier to call the market longer term than I do short term. I think short term, the Fed does something you don't think they're going to do like they did today. All of a sudden, everything reverses in the market. I think that kind of stuff's really hard to prepare for. Check that out and join us on Saturday, January 4th. We'd love to have you. All right, a few more things before we wrap up today. So first of all, S&P 500, when you look at that, this is a daily chart going back 6 months. And if you look back, I would say this is the worst day the S&P 500 has had in the last 6 months. And we were fine at 2 o'clock. I mean, this weakness all took place in the last 2 hours. But here's what I find interesting. The Fed's talking about inflation, that they're not quite sure about inflation at this point. They kind of got it going toward their target, but now they don't think it's going to hit their target for over 2 years. But when, we move down like this, I want you to look at some of the more aggressive versus defensive ratios that I have under this chart. So the first one, the QQQ versus the S&P 500. QQQ is more aggressive because many of those Mag 7 stocks and many areas, looking at semiconductors, software, they're much more heavily represented in the QQQ than they are in the SPY. So as a result, we like to follow the QQQ versus the spider just to see if the market is in risk on mode. And what's interesting is, we pulled back a little bit today, but I wouldn't exactly say this was a huge, massive sell-off on a relative basis out of growth and a huge lesser amount, in value. In fact, some of those charts I was showing you, like on the returns on some of the sectors, we still had, for the last week, we still have consumer stocks near the top, technology, second best performing group. And then even when you look at today's action, yes, consumer discretionary took a hit, but there's still a lot of value stocks that are down toward the bottom of what, we saw transpire today. So I want you to check out this, the QQQ versus the spider pullback. We started to pull back at the beginning of the week. Actually, Monday was fine. We pulled back a little bit on Tuesday. And then today we fell a little bit more. Then we look at discretionary versus staples. I mean, we're in a nice uptrend right now. We did go down today, as I pointed out. Discretionary was down 4%. I think staples were down 1 or 2%, whatever it was. So we did see relative weakness in discretionary today, which saw that resulted in this move lower. But I need to see more. I mean, if we're literally, if the market's going to be impacted by the fact that we'll have higher inflation and market values need to be adjusted, market valuations need to be adjusted, we should be seeing a much bigger drop than what we saw today in discretionary. How about looking at growth, large cap growth versus large cap value? I mean, we have been surging for the last month. And today, yeah, we pulled back a little bit, but not a lot. I mean, it wasn't like this huge drop. Again, go back and look at what happened here. This was the biggest drop in 6 months to the S&P 500. And we're worried about inflation and we're having fewer rate cuts as a result. That should be killing growth stocks. And I see a pullback, but I don't see, I mean, right there, do you think that's growth getting killed? I don't think so. Large cap growth versus large cap value. Here's another index showing the same thing. A little bit of a pullback. How about mid cap growth versus mid cap value? In a nice uptrend, we saw a little bit of a pullback. And then we've got small cap growth versus small cap value. Still in an uptrend, a little bit of a pullback today. But again, it's not, if we were getting just a mass exodus out of growth stocks, these lines would be shooting lower. And again, we got, more time. We got the next couple of weeks. Let's see how these different ratios move. But if we see this move back up to another high after the announcement comes out, that's going to be telling me that perhaps the selling that we're seeing has a lot more to do with options expiration on Friday than it does about the future direction of US equities going down the road. So anyway, I just wanted to point that out because I thought this was a really, really important intermarket relationship chart to share with you. All right, S&P 500. So what I want to do here, I've got daily charts, and I just want to point out quickly some of the areas to look for. I mean, listen, the S&P 500, we lost the 20-day moving average. We lost the 50-day moving average. We are now down at key gap support from the Trump trade. When Trump won the election, we saw a big gap up. We haven't traded below that level. We went right down to that area. So those are a couple of things that I thought were definite negatives in the short term on the chart. But I've also provided a couple of key areas that I would watch to the downside between somewhere around 56.75 and maybe 57.80, something like that. That's about the area of support that I would be looking for. I mean, the way we finished today and the VIX being up 27, I think in the short term, we could see more selling. And if we do, these are the areas that I would be watching. This is the couple of areas I'd watch for on the S&P. The Nasdaq didn't lose a whole lot, but we did lose the 20-day moving average. And we saw volume picking up. Volume was heavier. And remember, volume was light until 2 o'clock. This was Fed day. There wasn't a whole lot of stuff taking place. So the volume in the last 2 hours of the day was absolutely off the charts. I mean, I can show you a 5-day chart here on the Nasdaq. Look at the volume picking up in the last 2 hours. That's where most of the volume was. Prior to that, Nasdaq 100 was going sideways on very, very light volume. So keep in mind that even though the volume doesn't look that great, if we compared volume in the final 2 hours to the volume in the final 2 hours of every day over the last year, I don't know. This might have been one of the strongest 2-hour periods we've seen to close out a trading day. IWM, marked a couple things here. First of all, I drew a line to connect the highs, and then I took that same line and connected the August 5th low, just to say, if we were to go back down, because that's where we saw panic on the IWM back in early August. So if we're seeing panic on the IWM again, let's watch this channel. The tops firmly established, and now the bottom, 215. That also coincides where we've seen some recent price support, 215, 216. So I kind of feel like we lost the 50-day moving average. We lost the recent low. We lost the gap support from that Trump trade. All of that went in the final 2 hours today on very heavy volume and with the VIX soaring. So again, I'm thinking we're probably going to see a little bit more follow through to the downside. And I would be really interested to see whether or not we hold around the 215 level. We closed at 220 and change today. So that's a level I would watch. And then the key area that I'm really focused on too is technology. Technology had a big down day, lost the 20-day, lost the 50-day. I would probably be focusing at this point on this low, probably these couple of lows down in the low 220s. I think if we were to go down below the 220 area, I think that would be a big, big problem. And I think instead of having a short-term chart that's trending higher, I think that would start to maybe show a little bit more weakness from an intermediate term perspective. So there's a lot here to digest. I could go over so many individual stocks. Let me give you one individual stock that I thought really took a hit today, and from a technical perspective, could be setting up for a lot more weakness, and that's Netflix. Netflix, first of all, if you look at the chart, higher prices, lower PPO, right? So I'm already a little concerned. But when you give away the breakout level and the 20-day moving average with a negative divergence, and you break down and you see the volume pick up late in the day, like Netflix did, again, if you look at the daily chart, you're going to be saying, well, the volume wasn't that great today. I mean, it picked up a little bit, but not huge. But again, it was after 2 o'clock that all of this hit. So I think you've got to look at this as a heavy volume breakdown of price support and the 20-day moving average. When these stocks fall, especially when it comes to options expiration, they can fall really quickly. So it'll be interesting to see what Netflix does here over the next couple of days. I would not be surprised to see a big drop. And if it does, I'll take advantage. I'll be using it to jump in at some point. I'll look for some kind of reversal, look for something in the market. But there's a possibility we could go down the 50-day moving average, which would be down to the 825 area. We're sitting at 889 right now. So that kind of a move to the downside on strong leading stocks can provide great opportunities. And so I do thank Max Payne some months for doing just that. But anyway, we'll see. That's all I have for today. Again, it's going to come down to what kind of panic, or if we do see panic tomorrow, the VIX moving up into the 30s. That's the type of market you really want to be careful of, because when the VIX is above 20 and rising, like we saw this afternoon, it is like a hot knife through butter in terms of the move to the downside in US equities. So you have to be really, really careful out there. Anyway, take care. Let's see what the rest of the week holds through options expiration. And then maybe, just maybe, we'll see a little Santa Claus rally later in December. Anyway, have a great rest of your day. Enjoy the rest of the week. Have a good weekend ahead. We will be doing these videos over the holidays, maybe might be on different days. So make sure you're subscribed to the Stockcharts channel so you can follow along there. And of course, like the video. We always like that support. But have a great weekend ahead, everybody, and happy holidays. Happy trading.